What's going on, fellow retail investors? Hey, everybody. Butcher Wall Street here coming at you. We are looking at Old Yeller and Jay Powell. Well, it's close to the end of the days here, so smoke them if you got them. As you can see, as someone in the Discord said, Janet Eastwood is also smoking in the intro picture. And speaking of Old Yeller, the Treasury Secretary, Old Yeller, says that the United States could be unable to pay its bills as soon as early June. And I don't know if you could see that here, but you see I called it back on April 13th. I went ahead and told everybody there's $130 billion spent by the United States Treasury last month, or each month. There's $113 billion left. Accounting for inflows, they should be bankrupt by the end of May. I called for the default the last time around, and maybe I was just early once again. Take a look at the Treasury's general account with $112 billion left, and they've got $113 million in expenditures each month. All of May still to go. It does not seem like, even accounting for inflows and taxes, that they're going to make it to June. As you can see, Old Yeller told us on 6/27 of 2017 that she doesn't see a financial crisis occurring in our lifetimes. What an absolute joke. At the same time, we've got this awesome article that just came out here from Reuters that I've got to share with you guys. Now, this is a really exceptional article that someone just posted in the think tank, so I'm like, you know what, let's go on and share this with everybody since we're already on the subject. Let me scoot this over a little bit for you. Yeah, let's talk a little bit of macro because it's really important. So, Federal Reserve Jay Powell, at his press conference tomorrow, Wednesday, is likely to get asked once again what contingency plans he has for the United States in event of a debt default. And again, he's likely to say that there's no central bank silver bullet to shield the economy from such a damaging event. This would be the largest black swan to ever hit this country. And the risk of default looms larger after Treasury Secretary Janet Yellen said yesterday the date the government may run short of funds to pay the bills under the current $31.5 trillion debt limit may be as early as June 1st. I don't see how a guy like me can figure this out 2.5 weeks before Janet Yellen. But apparently that's what's continued to happen time and time again. And time is running short, and President Joe Biden and congressional Republicans are unlikely to meet even for another week. So you've got Jerome Powell protesting that the Fed would have a role in trying to limit the harm to financial stability. In the past, debt ceiling standoffs that we saw in 2011 and 2013, the Fed developed a basically playbook that would provide a starting point for them to do that. But we've got major issues now that we did not have in 2011 and 2013. QE is currently impossible. Otherwise, inflation would be even more rampant. So the U.S. central bank's responses to debt limit-related market stress were laid out in 2011, and they've been using it ever since. So two of the key ideas that they developed back then were the repo agreements and the reverse repo agreements, as you guys already know. Let me fix this cam real quick. Well, apparently that's not going to work, but no matter. You guys don't need me. All you need to do is listen up. So two of the key ideas that they had back then were the repo, reverse repurchase, and reverse repurchase agreements that ensured liquidity for financial markets. Now these have become permanent Fed programs that they manage on a day-to-day basis. This, as you guys may not know, crashed on September 17th of 2020. And a lot of people believe that that's why the scamdemic was actually implemented, in order to try to continue QE, quantitative easing, in order to make more money and push more money into the economy that was extremely stagnant already. If market stress became apparent in short-term interest rates, the Fed could temporarily increase the amount available for the repurchase and reverse repurchase. This is the short-term sale of purchases of securities, such as treasuries. that can run into trillions of dollars. It's currently averaging around 2.2 to 2.3 trillion dollars every single day. 2.2 to 2.3 trillion, not B, but trillion with a T. So this might be necessary for the Fed to conduct monetary policy as things continue to get more stressed. And another tool that they have is suspending QT, which they're currently used to shrink their balance sheet each month. So QT is part of the Fed's move to tighten inflation. Guys, this doesn't really matter here. Let's see if it fixes it. Nope, not really. So let's just get rid of it entirely. There we go. How the Fed might act in a U.S. default. That does not look good. Anyway, moving on. Quantitative tightening is basically one of the ways that the Fed is trying to maintain control of inflation. They can pull about $100 billion out of financial markets every month, but they reversed that already by having to bail out these banks. That's why the regional bank S&P 500 ETFs continue to pull downwards as more and more banks become insolvent. So they've added on a lot of this back to their back into their balance sheet as they've had to bail out more and more banks. Take a look at some of these plot points to see if I've got them up here. Let's take a quick look back here. Check this out. These are bank failures plotted and sorted by date. As you can see here, what we have: IndyMac Bank with 32 billion, WAMU with 300 billion. In 2008, this is sorted by date. You can see the way that everything kind of cascades and dominoes into each other. This was over 500 banks. And today we have had 3 United States banks become insolvent. Silicon Valley at 209 billion, Signature Bank at 110 billion, and First Republic at 229 billion. This does not obviously include Credit Suisse and other banks outside the United States. So another tool that the Fed has is the Federal Reserve discount window, all right? And they used this starting back in 2011. But now this is something that they've seen really ramp up again over the last several weeks. A default on the debt of the United States would not extend to the $24 trillion stockpile of Treasury securities all at once. They would simply have to default on one bill and then one note and then one bond at a time as the interest and principal become due. So they would default over and over and over again if it were to occur. And in 2011, the top Federal Reserve staff basically stated that the central bank could accept any defaulted Treasury securities as collateral for its standing programs at the discount windows and repos. And they said that it seems appropriate so long as the default reflects a political impasse and not any underlying inability of the United States to meet its obligations, so that all payments on defaulted securities would presumably be made after a short delay. That was in 2011. However, they had envisioned that the bonds being accepted by the Fed at a market price would likely be impaired by their defaulted status. And following the bank failures that we've had over the last couple of months here with Silicon Valley, Signature, First Republic, the Fed has again begun a new lending facility that allows securities with impaired prices to be pledged at face value. This is the same terms that apply to the discount window loans that we just got done discussing. So, lastly, the Fed would involve removing defaulted securities from the market entirely, either through purchasing them outright or increasing their balance sheet or via swaps, which would trade their own holdings of treasuries on which there was interest and principal payments expected to stay at those values were in default. So we saw this happen multiple times in 2011 and in 2013. And they said back then, and I quote, "This would insert the Federal Reserve into a very strained political situation and could raise questions about its independence from Treasury debt management issues." They said, "I hope that gets into the minutes, but I don't want to say what I would and wouldn't do if we have to actually deal with a catastrophe," they said at the time. And Ben Bernanke, the Fed chair, said, "So you're willing to accept loathsome under some circumstances," which drew laughter from some of the people. And Jerome Powell responded, "Yes, under certain circumstances." So really, the Federal Reserve has no silver bullet, had no magic answers for default on the debt by the United States. Taking a look at those possibilities is something that's very realistic at this point, because you have now the S&P 500 regional banking collapsing. Slowly but surely, a drawdown back in March from around the $60 to $65 range to about 42, trying to trade sideways, as you can see here in a descending wedge, as it reaches 40 and breaks down below it once again. Take a look at KBWB. This is the Invesco KBW Bank ETF. Then you've got the NASDAQ Regional Banking Index, the Western Alliance Bancorp, and PacWest Bancorp individual stocks. These are going to be massive effects of collateral cascading throughout financial markets, and ETFs and indices will also be affected greatly. Commercial real estate is going to be absolutely destroyed for decades, and insurance companies are going to feel this next. Yes, insurance companies. Just like you saw JP Morgan buy First Republic Bank for pennies on the dollar, that's going to happen repeatedly, over and over again. And tomorrow is the Fed day, the FOMC. The data we see today shows deepening signs of a recession. This almost assures that the end of the rate hikes are here and a Fed pivot will occur. The sad part is that a true market crash has never occurred until after the Fed pivot. Given the backdrop of the FRC bank failures that we saw yesterday, the market is begging for the Fed to stop rate hikes. Banks are begging for the Fed to stop rate hikes and begin easing, and stocks are taking this badly. Take a look at the SPY today, drew down another 1.12% in that effect. Take a look at DXY today, down from 102.5 to just under 102. Pretty big drawdown for a single day. This was in a matter of minutes. Even though it did pump all the way to 102. Ten-year government bond yields collapsed sub 3% as well. So tomorrow could possibly be a complete reversal here on what we've seen so far. And the stocks being down are in expectation of the rate hike cycle ending. Okay, this is what big money and institutions want Jerome Powell to do. It is stated that without high real estate prices, you don't need banks, right? You don't need insurance companies, and you don't need employees or offices or money at that point. So the whole financial side of the world industry could collapse, while real side inflation could continue to grow. This is the end of financial bubbles in a microcosm. The government is doing everything it can to redirect money away from areas that it thinks that we can't use to keep world leadership going along with the central bank's plan. Just like when they abandoned manufacturing in the 70s It is now directing money into industries and things that it thinks it can save or needs to regrow. Only the big banks and industries that grow, that it believes it can grow, will be propelled to the next level in order to maintain the central bank's control over the world. Just like they did when they encouraged financialization and industrialization after the 70s. As you all know or may not know, this is pretty much similar to when the gold standard was abandoned. And I have the price of gold up here somewhere. But apparently I misplaced it. There it is. Put it in the wrong spot. You can see gold still over 2,000 today, up around 22.79% over the last 6 months. Take a bigger look here, deeper look into, WAB, Western Alliance Bancorp, Zions, Charles Schwab Bank, Huntington Bank Shares, and PacWest Bancorp. I could not be more happy that I left this fucking bank. Should I say PacWest? Ricky Carrillo, thanks, buddy. Appreciate your super chat. So really here, what we're seeing is the end of excessive financialization taking hold of a financial system with a flight to assets that have a higher chance of remaining solvent, like gold and Bitcoin. That's why over the last 6 months, Bitcoin's up 41%, even after crashing. Gold is up 23%. Silver's up pretty heavily as well. Look at this. There was a total collapse in regional banks on the KRE ETF, and then we're seeing FRC, PacWest, Western Alliance, and Zions, among other regional banks, in free fall. And now you're looking at big banks getting absolutely hammered right along with them. And the majors indices here instantly dropping at the U.S. cash open, led by the Dow and the S&P, both down over 1% today. Even heavily shorted stocks, for the most part, most heavily shorted stocks are getting hammered lower. But what's not? The VIX1D. This is the new one-day volatility index from CBO. So just like there are 0 day to expiry options on the SPY, due to the massive amounts of issues going on in the S&P 500, I allege that the plunge protection team has been having to buy the shit out of the SPY and naked short the hell out of the VIX. So much so that at this point they decided to come out with 0 day to expiry options on the volatility index. That's called the VIX1D. Today that spiked from around $9.50 to $14.67. This caused a further drop in a further surge and then drop in bond yields, mostly driven by an illiquid market. And it's reversed entirely. The surge that we had reversed entirely with yields that collapsed this morning. All right. And now even the 2-year yield, I showed you the 10-year just a few minutes ago, and now looking at the 2-year yield, has dumped below a 4%. And that's the same level it was at on April 27th when it broke above that line. Look at the rate hike expectations. Rate hike expectations today dumped because big banks and market makers and funds think they can trick Jerome Powell into making this the last rate hike. And I don't think I believe that to be the case. That's why people are fleeing to gold. That's why central banks are buying up gold at a clip that's never been seen before in history. And even Bitcoin is being seen as a safer place to put money than the dollar by many. Meanwhile, oil prices like WTI are starting to take a turn. Downward trend. today's data that we had was recessionary. We had job openings, we had JOLTS, labor data was lower than expected. Factory orders were lower than expected. And the Bureau of Statistics stated that 178,000 people got fired. Meanwhile, gold rallies, the dollar weakens as people expect the Fed to ease. And then bonds start rallying on bond prices. Meanwhile, yields collapse under the expectations of Fed easing. And of course, the SPY is down only 1% at that moment. So in reality, we've got a long way to go here before we see the end of this. And I will say today, also one more major piece of news. MB here, 741 Trey, found this today from the DTC. And basically it states that effective today, May 2nd, the DTC will apply a 100% haircut and assign no collateral value to securities issued by an affiliate of any lender in this table. And these are lender banks to the joint DTC and SEC 1-year line of credit facility dated as of today. That means that all these banks, from Agricultural Bank of China to Barclays to Citizens, HSBC, JP Morgan, Lloyds Bank, Santander, State Street, Susquehanna, Bank of New York Mellon, and even Wells Fargo and US Bank, none of them will be able to use the securities, or their stock will be able to be used as collateral security, because the government and the DTC have absolutely no faith in these banks maintaining solvency whatsoever. Therefore, the DTC is no longer accepting their stock as collateral in any way. 100% haircut means completely fucking worthless. Yeah, Neil Nice brings up a great point. In '08, didn't the SEC freeze trading over 300 banks? Yeah, they seized actually the short selling of banks for a significant period of time because there was way too many banks that were going insolvent. And I think it's only a matter of time before we see that happen once again. But to think that we're in a bull market simply because there's a bull run in the middle of a bear market would be juvenile, naive, and ignorant. Look at that. You can't even see a damn thing. Never mind on this. No matter. This right here is the important takeaway. The 3 banks that have collapsed thus far greatly eclipse anything we've seen out of the 500 banks that collapsed in the years preceding 2008. It's because of the poor lack of financial security and the over-leveraging by these banks that we're currently in this situation. And your pension and 401k and IRA, if it's not self-managed, these assholes are putting it in the first place they can find to make you a bag holder. That being said, make sure you're properly hedged. Act accordingly. I wish you all peace and wealth. Make sure you're properly hedged. I'm not a financial advisor, and I don't know your situation, so I can't tell you what that is for you. But those of you that are properly hedged, I think it's pretty safe to say that we're going to be so fucking rich. And the majority of people, sadly for them, are going to be so fucking broke. So I hope that most people will act accordingly. Thank you, everybody. Have a great evening. Wish you peace and wealth.